Do you know which Vanguard ETFs are the best for retirement? That's exactly what we're going to be looking at this video today, looking at the 3 perfect Vanguard ETFs when it comes to retirement. And I'm also going to show you some insight into the personal portfolio that I have set up that does have these Vanguard funds. Now, when it comes to investing, there are a few things to consider. Number 1, the cost. Number 2, the diversification. This is really the baseline when it comes to the ETF and the 3 core, essentially ETF investing strategy that we do utilize. Now, when you start looking at the Vanguard lineup ETFs across its 86 ETF roster, more than 50 of the funds come in at a 0.1 or less, making Vanguard one of the absolute cheapest companies when it comes to ETFs and when it comes to the overall expense ratio. The other thing to remember is when you look at Vanguard, they are really core bread and butter. Almost everything that they do have lines up to an index offering exposure into either an entire sector or an entire market, which is not really particular tied to risk, because you have a lot of essentially exposure out there to the market. There are a few funds out there from Vanguard that really stand out and fit this bill. When you start looking at the funds, they're well diversified. They have a very low cost, which is the reason why we're looking at these as really the core of the retirement portfolio that we're building with the 3 ETFs. Now, starting with number 1, it is the Vanguard Total Stock Market ETF, or the VTI. This is one that I do hold personally in my portfolio. And this one, of course, is the total index. That is the VTI, the total stock market. This does encompass having the large cap, the mid cap, and the small cap. Now, this does vary from our VOO or our Vanguard S&P 500, which only has the 500 largest companies within the United States. This includes the small caps and the mid caps. Now, of course, the small caps and the mid caps have kind of underperformed over the last 15 years what we've seen from the VOO or those large caps, but it adds a not only important growth aspect to this portfolio, it also adds a huge diversification aspect. When you look at the VOO, it holds about 500 plus stocks. When you start looking at this one, you're at 3,700 stocks, which again is kind of crazy because you have your exposure to the entire US market. You're not concentrated on small companies. You're not really concentrated on those medium companies, because looking at the cap, at the large and the mega large cap stocks, this holds roughly 75% of the assets, but it is not 100% like what we're seeing with that S&P 500, which is the good reason why it is adding in that diversification piece. Now, second one we look at, which is the Vanguard Total Bond Market ETF, or the BND. This is one from Vanguard where the bond market, I do not invest personally in the bond market, but I know there is a lot of recommendations. A lot of financial advisors that I work with do recommend holding bonds into a portfolio. Could be at a very different kind of a percentage when you start looking at the core, when you start looking at the growth, and then when you start looking at the third one. Some people are going into the bond market. Some people are going into the dividends, really holding some of those dividends. The Vanguard, actually the VYM is what I personally hold. That replaces the BND or the bond market. But if you're looking at the BND, it makes perfect sense because this is the total bond market. So very similar to what we see with VTI, where it is the total market index. This one is the total bond market. So that is right. Now bond has become some of a notorious word because bond is really long-term relationships. Having something like this, unfortunately, we don't see the growth. That's kind of the problem that we see. We see a big essential spike in the bond market when rates are high. As the Federal Reserve continues to fight inflation, the value of bonds are going to continue to go lower. And even looking over the past, 10 or 15 years, majority of the bond funds are yielding about 1 to 2%, which we know is just astronomically lower than pretty much everything else. If you look at the VTI, the VOO, all of those do have a much higher return, which if you're essentially putting money in those versus those bonds, you would have a much higher return. Now, of course, there is a drawback because when you look at this, almost 2/3 are invested in United States treasuries, which this includes government bonds, notes, bills, mortgage-backed securities. If there is any fault or any problem with the United States government, it is going to crush the bond market. Now, again, not saying there is anything going to happen, nothing negative, but overall, if you are invested into that, again, even with a small portfolio, there's a lot better options. But the final one that we look at is another one that I do personally own, which is the Vanguard Growth ETF, which is the VUG. When you think of the larger cap companies, when you start looking at the very large tech companies, this is exactly where the growth is coming from. When you look again, probably at the last 10 years, looking even at the growth of AI and the future focus of what we have with artificial intelligence, this is going to really grow at an exponential rate. And that is exactly what we're seeing. Performance does incredibly well, even though the recent performance, it has some little ups and downs because again, when you start looking at tech, there are heavy upswings, heavy downswings, but overall, when you look long-term, it is a really good place for growth. If you're younger than 30 and you need money, this is a great place to put money when you're building out this portfolio. And again, we're going to talk about the percentages, and then I'm going to look at exactly how I'm kind of investing it. Because of course, when you look at this growth factor, putting it into a majority of it into growth, again, depending on your age, let's say your 20s, your 30s, your even early 40s, you're looking at the growth factor at this point because you might have another 40, 20, 30, 40 years plus till retirement. And then of course, you do need to see some of that growth in retirement. A lot of people don't realize where, let's say your target age to retire is 65. At 65, you still have essentially 65 to let's say 87, 90 years old. So you have another 25 years of growth that you can get out of these ETFs. Just because you're getting into retirement, you start drawing maybe some of this money out. It doesn't mean it doesn't have to grow. A lot of people need to take that with a grain of salt. A lot of people, will get to a certain point of their career, start pulling an incredible amount of money out of these retirement accounts, and then all of a sudden they don't have anything left. There's nothing growing. You're not seeing the compounding. Using the 4% rule, being able to get it to a point where essentially you can take 4% off. Rest of it is going to cover inflation and also the growth factor, meaning that you never have to touch the original balance. Now, looking at this one again, the future growth expectations, very heavyweight into that technology. So if we ever see a tech bubble, anything like we've seen, 25 years ago, could really have a big impact on here. But overall, it is something that for the long haul, I am putting a lot into. Now, again, thinking of a portfolio like this, where we have kind of a build out growth fund, earlier age, I would probably put at least 50% in there of this growth fund. You could even do 50% in growth. You could do 25% in like the VTI. And then again, you could do the BND. I wouldn't do it. And again, I really don't recommend it as much as I like the trade portfolios that they put in here. But overall, I would put it into the VYM, which is the Vanguard, which is their dividend side, which again, I'm going to show you. So let's hop over and we'll take a look at it. All right, guys, so here we are looking at the portfolio. As you can see, we have about $1,100 in here. And overall, the starting value was April 9th of 2024. So we have had this about a month in here. You can see net cash flow, we put in 1,064. Now we are making regular contributions in here. As this is, you can see right up here, the kids investment accounts. These are investment accounts that we are going to start now and essentially let them grow through an extended amount of time. When it comes to college time, when it actually comes to retirement time, getting at least probably $10,000 would be a great earmark in here. That way, if it is getting to retirement, and most of you know that I do have young children, is if we put $10,000 in here today, what is that going to look like in 40, 50 years when they get ready to retirement? Chances are with regular contributions in here, that could be north of $1 million or a few $1 million that are sitting in these investment accounts. So looking in the course of the last month, money weighted return almost 5%. We're looking at 4.67%. And like I said, with the build out that we're doing right here, I have the VYM, which is that was the one we were just talking about. This is what I would replace for the bonds. I would put the VYM, the Vanguard High Dividend Yield, in here versus doing the bonds. Then we did the VTI, which again, we talked about in the video. And then we do have the VGT in here, which is the information technology, versus doing the VG, because I actually carry that in my other portfolio, which is my personal investment and retirement portfolio within here. So these are the three that I made. Now you'll kind of look, we did even percentages in here. Depending where you are, we could actually go in here and build this out, put a little bit more into the growth. Like I said, putting that 30% into, let's say, that VGT or the V as the growth fund, because we have an extended amount of time to actually grow it, putting 25% in the VYM and the VTI. And you can see the exact reason why. Now, when I set this up a month ago, we did even 34, 33, 33. But as you can see, even looking at the growth factor as it sits today, we have had the VGT actually do the highest return that we've seen at 3.51%. And again, this is over a month. When you start looking at, the standard or the regular return of something like this, you can go in the VGT details And when you start looking at a longer term, let's say the 2-year, let's say even the 5-year, when you start looking at this in 5 years, we've seen 160% return. Of course, this is very, very heavy tech focused. When you start going down here, you can actually see, you can go to the company website, but you can see that they are holding stocks and they are holding tech stocks, which is the exact reason why I do put it in here, is making sure that we do have the ability for these tech stocks to build and really grow over the next extended amount of time. So this is, again, the portfolio that I have in here, my personal portfolio, which we'll actually show you right over here, which is this one. So this is, like I said, where I was holding the VUG. This one I am actually holding the QQQM, the VOO, and the HD. So this is the other kind of diversification. And as you can see with our growth fund, we do have the 40% in there. And then we did 30 and 30. So again, focusing on the growth. Now, overall, in the last 2.5 years, almost going on 3 years, we've got about a 65% return, which is kind of insane. That is achieved through dollar cost averaging. We have been dollar cost averaging into here for an extended amount of time, which means we are putting a set amount in every single week and just going in here, dollar cost averaging, and really building out this portfolio. And again, we've seen a 65% return, which is kind of insane in that time frame. So we have the two portfolios kind of built. And then of course, the third one that we have, if you guys caught it, is the YouTube AdSense. That is right. This is YouTube AdSense. Every single dollar that we're making on this finance channel, we are putting into the YouTube AdSense. This is where we're putting it in dollar for dollar. Even here, we voted, we said the HD was where we are putting it, and we are putting it in its entirety in here based on the revenue production that we're making within YouTube. But all right, guys, that is the portfolios that I do carry. If you're interested in M1 Finance, definitely click the link down below, but let me know in the comments what you guys think. And as always, thank you guys for watching.